in March, the month of March, especially around this time, specifically this week, the market tends to go through cathartic moments, either coming out of a bear market or perhaps relapsing into a bear market. And here we are again. And often the trigger is something financial, something in the banking system. So here we are again. And I think this time, just to cut to the quick here, I do believe that with the banking failures that we are seeing, Silvergate Bank, Silicon Valley Bank, and there may be a few more regionals, but we do not think this is a systemic banking problem. We do think it will cause a different kind of conversation at the Fed. We've been talking for a while about monetary policy and signals that that monetary policy had gone too far in terms of tightening. And I do think bank failures are a wake-up call very often for policymakers generally and the Fed specifically. So we think that's going to be the case this time as well. But we're beginning to see brewing here a banking crisis. And the question we have to answer is this going to become systemic like Lehman Brothers in 08 or 09? Or, and we're betting on this latter one here, is this more like 1994 when Orange County went broke and that created a crisis to which the Fed responded? We think it's much more like 1994 because the setup was similar. In 93, 94, commodity prices had taken off as we were coming out of that recession. It was an S&L induced recession, so housing. And the Fed was railing against those price increases with higher interest rates. It was a terrible year for growth stocks. And that's how we would characterize 2022. But when Orange County went bust, that was a sign that the Fed had gone too far. And the Fed did change its spots. We believe that the failure of Silvergate Bank and Silicon Valley Bank, which just went, the FDIC put it into receivership today. Both of those are telling us a couple of things. One, that, the Fed has gone pretty far and is causing a lot of banks, not just these, difficulties. And I'll describe how in a moment. So we do agree with those who say, well, Silvergate had a concentration of crypto customers, and Silicon Valley Bank had a high concentration of venture and venture-related customers. And so that's all true. But if you look at what has happened here, it is the deposit outflows that have triggered the problem, the crisis. We know that venture capital is facing a bit of a liquidity squeeze. Fewer deals are being done. There is more risk aversion in the marketplace. And so these companies are having to draw down their deposits. Most bank with Silicon Valley Bank. They're drawing down their deposits because they have to. And there are others perhaps at Silicon Valley Bank who are saying, wait a minute, I'm not being paid anything here at this bank, or not paid very much, so I'm just going to put my money in a money market fund until I need it. A lot of banks are facing that latter risk. If you look at the money center banks, the big banks, they hardly pay anything on deposits. And so money is fleeing to money market funds. Now, that's not going to present a difficulty for the big money center banks. They are extremely well diversified. Most of them have nothing to do with venture, or if they do, it doesn't represent a big percentage of their business. But there are smaller banks out there that are facing some issues. And I'll just say one more thing about the large banks. Because of what happened in 08, 09, they have been forced by regulators into capital ratios, which suggest that today they are extremely well capitalized, and they're like Fort Knox, so very safe. So this is no Lehman moment. However, there are small regional banks out there who were not subject to the same kind of capital ratios, and they therefore have been taking business that used to go to the large money center banks, perhaps disproportionately, and moving more into funding venture companies, or they've been moving into commercial real estate. Historically, they've had a big position in residential real estate. As you might imagine, local banks know their local customers, and so residential real estate. But now, on average, 25% of their loan book is in commercial real estate. And what we have to watch here is the office part of commercial real estate. Offices are empty now. There's been a lot of building going on, and those new buildings are getting all of the attention, and the older buildings are really the vacancy rates are quite high. So we are seeing what is called strategic defaults, and what that means is that the borrowers are going back to the lenders, like these regional banks, and saying, our vacancy rates have gone up. We can't, our cash flows aren't there. We got to renegotiate this loan. So we think there are going to be a lot of renegotiations, and it will halt a lot of activity. And I do think that it will get into the economic statistics. So I just want to make sure you understand, we do not believe this is a Lehman-like moment, but we do believe there are some banking issues out there. And certainly the bank indexes in the stock market, if you look at them, you will find the regional banks have been disproportionately hit in here. The money center banks haven't been doing that well, but they're kind of steady state. So the market is making that distinction. So just a little bit more of what has happened here. During 2020, when we were going through COVID, there was a huge amount of stimulus, as you will all remember, and many banks had incredible inflows, deposits, and both Silvergate and Silicon Valley Bank were two of them. So here we are. Now, what are they going to do? Well, Silvergate really didn't make loans. So it bought securities, liquid but long-term oriented securities, fixed income. And you'll see that Silicon Valley Bank did that as well. Silicon Valley Bank, which went under, took all that money, and if I remember, it was in the $70 to $90 billion range, and put it into these long-term instruments to earn a higher yield than in the money markets. At that time, money markets were paying maybe 0.5%, and they got 1.6% on average on that money. Now, the assumption they were making is that interest rates were not going to go anywhere anytime soon. And of course, that it has proven to be wrong. Interest rates, as I've mentioned on this webinar many times, have gone up, I think it's 20-fold in less than a year's time. That has never happened before. And I hearken back to 1981, when Volcker was trying to squeeze inflation out of the system. He took interest rates up twofold, from 10% to 20%. True, a high level. But the shock, already people had gotten used to interest rates going up, so they were preparing for it. So the shock from going from 10 to 20, there was some shock value, but nothing like we're seeing now.